live.
Hands?
I have got the go live button.
Okay. Welcome, everyone. We are
Slide.
seriously getting started now. I apologize for being 13 minutes late to launch this, but we wanted to be able to share this live on YouTube as we were doing this. I appreciate the patience of our Zoom audience. We are thrilled to have you all here. And I am excited to introduce our speaker and to tell you a little bit about today and what we're doing. Let me start, if you will. I'm going to share my screen and share a few thoughts here quickly. But for those of you who are watching on YouTube, and we hope there are lots and lots of you out there, we've shared this in lots of places. But if you're watching on YouTube, we invite you to join us in the Zoom room where you'll be able to ask questions. And to do that, visit aug.s4g.fund. Think of that as August for SuperCrowd Fund, aug.4sc.fund. We're excited to have you with us today. Our purpose rounds is our primary impact sponsor. We're grateful for them. Our supporting co-hosts include Rotary, SuperCrowd, or Superpowers for Good, Funding Hope, Amoeba, Move the Needle with Rob Kaplan, and Ridgecrest Herbals. Also, we have our co-hosts, the Gig Group, Jenny Casson Group, the CFPA, the Crowdfunding Professional Association, Crowdfund Better, Mashup Labs, and CrowdMax. We're grateful for all of their support, and we're especially excited and so grateful to have with us Bouhelier-Gautreau, who is the head of impact investing at KingsCrowd. And she's going to be talking today about how to start investing for impact with just $100. So you do not want to miss any of this. So please stick around for her entire presentation. If you have questions, we invite you to use the Q&A app to share your questions with the group. Thank you very, very much, everybody. And I'll turn the time over to Leah.
Amazing. Thank you, Devin. And thank you so much for having me today. As I was telling you earlier, I can talk a lot about impact investing. So we're trying to stick to the clock today. Let's dive right into it and see how can we start investing for impact with only $100. Today, we're going to cover both content and explanations for people who never invested into any equity crowdfunding platforms, but we're also going to dive a little bit into some exclusive data provided by KingsCrowd in order to also satisfy the interest of industry expert and anybody who wants to dive more into the online impact investing space. I'm Bouhelier-Gautreau, Senior Investment Analyst at KingsCrowd, where I have the chance to analyze a lot of deals in the impact investing space from a variety of industries. I'm also a part-time MBA student at UC Davis Graduate School of Management. And at Davis, I'm also the president of the GSM-led Impact Club, trying to always provide students with more information and curious perspective in the impact and sustainability spaces. Today, we are going to first do a quick introduction about online investing and impact investing to help anybody understand and be able to follow the entire content that we have for you today. We are also going to dive into a little bit of the trends of the online investing market by looking at some data. And we are going to finish by looking at a few specific impact deals that are offering good products, but that perform differently on the online impact investing platform, some getting some getting amazing amount of funding, while some having not as much as they would like to. We're going to focus today on equity deals, meaning safe, convertible note, equity common, equity preferred, and equity token. And we're not really going to talk or look at the data related to revenue share and debt deals. The main reason is because the type of deals and the type of companies raising for these different asset classes are different. On the revenue share and debt side, we have mostly small businesses with limited growth perspective, while on the equity side, we have startups. And for me, high growth also means high impact, and that's why I love focusing on equity deals. A little disclosure right here, I do not really personally recommend in any of the startup that I'm going to be presenting today, and always do your due diligence before investing. Remember that investment in startup are illiquid, so never invest more than you can afford to lose. Let's go back to the basics, right? Everything in equity crowdfunding, starting really around the Jobs Act in 2012, when the United States government allowed for startups to raise online and retail investors, regardless of the income level, to be able to back startup with as much as $100. So we have a few platforms that really emerge and are kind of concentrating most of the impact deals right now. We have WeFounder, Republic, Start Engine, Macro-Venture, Net Capitals, for example. But if you're looking for impact investing specific platforms, you can also go on platforms like Raise Green or We Climate, and you're going to have curated deals specifically for impact investing. As every investor, I will advise any of you to do your due diligence. And if I can share my due diligence template in a few minutes for everybody who's starting out there, the first thing that I like to look at when I'm analyzing a startup deal is the team. Is the team competent to lead the startup that they're trying to build? Are they motivated enough to go through the hard times of building a startup? I also want to see whether the market is going to grow quickly and if the startup can really get market shares without having to fight too much against competition. And so we're also going to look at the competition. Is the product that a startup is offering better or cheaper than the competition? Is the company executing quickly and well, and can it outpace its competitions? These are questions that we really have to ask ourselves. And we also want to wonder, is the company raising at a fair valuation with favorable terms to investors? Are you going to get a good return on your investment when you invest in this company? Can the valuation of this company actually grow? These are kind of minimums that every investor should be asking themselves before they start investing into any company. Our for KingsCrowd, and KingsCrowd helps investors do the due diligence. We are an aggregator and research platform on a mission. That means that we collect data and we rate companies. We rate every single deal that is available on equity crowdfunding platforms. We provide in-depth analysis for investors, as well as in-depth research. And we're going to feature our favorite deals on KingsCrowd platform to really help investors quickly identify the most interesting opportunities. Thanks to KingsCrowd data, I've been preparing some of the content that we are going to see today. But before we look at the content, let's get clear on what is impact investing. There are a lot of different definitions out there, but I like to define it. Impact investing on the online equity crowdfunding market is investing in companies that have products that directly have an impact. By impact, to understand impact, I try to ask myself these few questions. Is the product solving a social or environmental challenge? Which means, is it fighting a social injustice or discrimination? Is it fighting gender, racial discriminations? Is it trying to help citizens afford housing? These are part of the companies that are trying to solve this problem. They are part of impact investing. I'm also trying to see whether it is ensuring access to basic right, meaning education or water, for example. And we're also trying to look at whether these companies are mitigating climate change or maybe kind of attenuating the consequences of climate change or trying to preserve biodiversity. All of the companies that have product that will be solving problems in these areas will be considered impact investing deals. And we have to be careful as investors to differentiate impact investing from companies that have great ESG initiatives, ESG meaning environmental, social, and governance goals and initiatives, but that are not directly having a positive impact on society, on the environment. And let's take an example. I've seen recently a beer company that is entirely powered by solar panels. This is a great idea from this company. They're not really harmful to the environment, at least they're limiting the externalities. However, the company is producing beers. So the company has great ESG framework and initiatives, and they're really following the right path, but I will not consider that as impact investing. And as investors, we have to be very careful about greenwashing. Some companies sometimes are using the term sustainability to describe themselves, while they are not really having a good, positive impact on the environment, right? We have, for example, airline companies or oil companies, or just basic CPG companies like baby diapers that are kind of putting green colors on their product and trying to make us think that they're having a positive impact on the environment, while really it's most of a marketing play. So let's be careful about that. So let's really now take a look at the online equity impact investing market and see what it looks like currently. And I have an alert for you right now. Be careful. I've put a lot of charts in the next slide. So if you're a nerd like me and you love data, you're going to like it. But if you have glasses, this is the moment to put them on. I really wanted to provide everybody with detailed data. So if you're watching us on YouTube, you can pause, you can look at the industry that you really like, and I don't want you to miss any of the data that I'm presenting today. Let's take a look at the platforms. Which platforms are actually offering the most impact investing deals? While looking at the data since January 1st, 2021, we see that WeFunder, Dharma Group, Start Engine, and here Republic at 8% are really the platforms where we have the biggest number of impact investing deals. Let's now take a look at what do these deals actually look like? And to do that, I took all of the deals that were impact investing on equity crowdfunding platforms since January 2022, and I divided them by revenue stage. So we're going to look at a few data points based on this company's current revenue. Let's start with the number of impact deals per revenue stage. We can see here on the very left, that most impact deals available online actually do not have any revenue. We then have a pretty good quantity of deals, more than 50, that have between $0 and $50,000 in annual revenue at the year prior to the current raise. And then we kind of have a very interesting zone right here between 500,000 and 5 million, where we can see that we have maybe close to 150 companies that are also raising in this area. So if you're an investor looking for pre-revenue startup, there are deals that are available for you on equity crowdfunding. But if you want also impact deals that are already showing some traction, that are showing a good product market fit, then you're also going to find deals that will be interesting for you. Let's now look at the valuation per the revenue stage of impact deals. This is very interesting and very important as an investor. You want to know what should be the normal valuation for any deal based on the revenue of this deal. We can see that if we take a look at the median valuation of equity crowdfunding impact deals that are at pre-revenue stage, you can see that they are at about 15 million valuation. Interestingly, for companies that start having a little bit of revenue, the valuation really drops at the median level at 10 million. What that says is that if you're investing at revenues that are about lower than 1 million, a deal which is valued at 10 to maybe 20 million is going to be pretty fair compared to the market valuations. When you're kind of passing that bar, be careful and try to consider, is the valuation really justified? Does the company has patents, a unique innovation? Did the company have to work for really years and raise a lot of capital to reach to where they're at right now? If that's not the case, the company may be overvalued. Let's now take a look at the outliers, because we just took a look at the median valuation of impact startups in the space, but we also have companies that have astonishingly high valuations. And we can see right here that we have a few pre-revenue companies that value themselves up to close to $1 billion. And so kind of repeating my warning here, if you look at companies in the stage, you have really ask yourself, is that valuation justified? And when you look at the rest, you can see that we never really have any company that is raising at more than 200 million in valuation on online equity crowdfunding platforms. And that is kind of normal because, as we're going to see later, because as we can see, actually, we already saw it right now, the revenue state of this company is pretty early, and it is normal that they do not have valuation that really exceed this amount. Let's now take a look at industry breakdowns based on the same timeline. It's interesting for investors to try to understand what is actually the offering looking like on equity crowdfunding platforms. This is what we can see right now, right? What is the quantity of impact investing deal per industry. And we can see that 23% of impact investing deal available online are in the energy, power, and natural resources industry. This is followed by the CPG industry at 12% and the transportation industry at 10%. So this is kind of the offering that you're going to have on the equity crowdfunding platforms. Actually, in the last year and a half, we only had about 8 companies in the media, entertaining, and publishing, and any industry that you do not see here probably had only 5, 8, or a lower amount of deals available. But let's now look at what investors actually prefer. Investors clearly, on this graph, invest the most money on energy startups and transportation startups. And I do have kind of an idea why. These are some of the industries that are really having the most negative impact on climate change, on the environment, but these are also industries where we have tangible products that can actually mitigate climate change and that have bright markets ahead. And I do believe that these are some of the factors that are really making investors prefer these industries to others. Let's now try to understand which startups in which industries actually raise money when they have revenue. And so right here, you have a list of the median annual revenue of startups raising online per industry. And what is very interesting is that on the apparel and fashion industry and the marketing and advertising industries, companies, at least half of the companies were having close to $1 million or more than $600,000 in revenue by the time that is starting investing, that is starting raising money. Which means that for investors in most of the industries that I'm present in right now, you're going to have companies that already have kind of a product market fit, that already have kind of a traction, that are raising online. However, it's not because a company has revenue that investors are actually attracted to it. Here, we're comparing 2 industries that have pretty close revenue, but different amount of money raised. What does that mean? The median amount of revenue of farming and agriculture companies was at close to $400,000, but these companies, at least half of the companies raising in that industry, only raise less than $25,000. While in the food and beverage industry, with a similar revenue, half of the company raised less than $100,000, and half of the companies raised more than $100,000. So you really can see that investors have preferences, and they are not directly related to the revenue of companies on the impact space. Now let's take a look at the few industries where most of the deals available online did not generate any revenue yet. And what is very interesting here, if you remember, we just mentioned a few minutes ago that impact investors' favorite industries were the energy and the transportation industries. And most of these companies are raising without revenue. What really tells us here is that the online impact investing market is mostly a pre-revenue stage market where investors are not afraid to back companies that are promising, that might be risky, that are going to take time to develop, but that will have a great impact. And now you have a ranking of the median valuation of companies per industry. That tells us if you're an investor, do not hesitate to take a screenshot of this data. It can be very useful for you in the future. If you want to understand at which valuation should you be investing in which company, in companies in which industries, this is the data that you need. At the very bottom, one more time, we have the favorite industries of impact investor, energy and transportation, which are raising at the highest valuation. Hope that you're going to make good use of this data, and this is going to help you invest and start investing in the impact investing market. All right, the chart alert is over. I'm done with all the data. I hope that you've been able to look through it, take a few screenshots, and get what you needed to really start investing. Devin, do we have any question in the Q&A? Do our listeners have questions related to this data?
Yeah, there's an interesting question that came up. You were talking about valuation and revenue, and correlating those two things. Would you? One of the questions that came up is, why is that important? Why does valuation and revenue matter as an investor?
Yes, the revenue of a company is going to give you an idea of the stage of the company, and mostly of the demand for the product. Therefore, it is kind of de-risking. It is de-risking the investment, and it's also going to provide you with an idea of, so this is in terms of risk, in terms of whether the company is going to fail or not. But we have to remember that for companies that will be acquiring the company, or for exit happening on the public stock market, what is going to matter for investors at this later stage is, can the company have a positive cash flow? Can it bring them dividend, or can it bring them profit? These are things that are going to matter. Therefore, usually, in a lot of cases, the revenue is kind of more or less correlated with the valuation, meaning that we can see that at later stage, we have kind of what we call industry revenue to valuation industry multiples, where we see that for a certain amount of revenue, a company is going to be valued at a certain multiple. We kind of have that rule of thumb that said that in tech, we often have a 10x revenue to valuation multiple, meaning that if you see a company that makes 10 million, it could be, and it has a kind of fast-growing technology product, it could be valued at 100 million valuations. So it's good to see the distance and kind of the multiple between the revenue and the valuation, because you can understand whether companies are raising at a valuation that is fair for you or that is way too high, right? If you start seeing 30x revenue to valuation multiple, you will have to ask yourself, well, is that the company's way too overvalued, or is that they really have patents that are going to support their valuation? And I don't want to say that you should apply that rule for everything, but this is part of the criteria that you should be looking at.
Excellent. That's a great analysis, Leah. What about how many are actually making money? As you were looking at this data, I kind of suspect that none of these companies, or very, very few, are actually profitable. But what are you seeing?
Yes, I don't have a chart specifically around profitability, but I really look at probably 10 different impact companies a week. And so from what I've seen, we're going to be at around maybe 5 to 10% on equity platforms that are generating revenue. And I think that I'm being quite generous here. I'm actually often surprised when I see a company being profitable. And the reason for that is that companies that are raising online is mostly because they need capital. It can be capital to grow. They can be profitable, we want capital to grow, but a lot of time it can be capital to survive, waiting to get revenue, waiting to grow their revenue and really be able to cover the overhead and to cover most of the operating costs.
Excellent. One last question before we let you finish your presentation, but how much are the impact companies typically offering in terms of how much are they typically raising?
Yes, we are going to actually take a look at that later, and I think I should have a chart related to that. Oh, all right. No, it's not here. So I'm going to give it to you from head. The highest median amount raised per revenue was for the energy industry at around $250,000, which means that half of the companies were raising $250,000 or less, right? Then we have a few industries like the transportation industry and the software industry, industries that are kind of popular among investors as well, that are raising around $100,000 for at least half of the companies. So same, right? Half of the companies are raising less than $100,000. And finally, for the rest of the industries, we're going to have median amount raised around $30,000 to $70,000. So if you see a raise that is already at $100,000 or $200,000, it means that this raise may be doing pretty good on equity crowdfunding platforms.
Fantastic. Well, Leah, why don't you continue your presentation?
Thank you, Devin. Let's dive into a few companies and try to understand why our investors deciding to invest or not to invest into companies. To do that, I've been selecting 6 different companies. And I've tried to take companies that come from mainstream platforms that have a lot of investor traffic. So the lack of investment in these companies will not be coming from a lack of investors coming over our platform. I'm also taking companies that have enough data and that have good pitch deck. So the lack of investment will not be explained by the lack of data, and companies that have no obvious red flags. So we're going to start looking at 3 companies that did amazingly well and 3 companies that are struggling a little bit more to raise capital on equity crowdfunding platforms. First, let's take a look at Timeplast. If you have not seen Timeplast's video, I really invite you to log in on Start Engine and look at this video. Timeplast is a bio-based plastic that can disintegrate completely in water in about 12 hours and turn into alcohol. In 60 hours, it's going to completely disintegrate. And so in the video, you see the founder putting a plastic into a cup of water, having it disintegrate, and then drinking it. And I think that most people here will not drink disintegrated plastic. But this kind of had, I believe, a wow effect on investors. It really attracted investors' interest. It attracted my interest. And I actually talked to the founder, Manuel Randall, to understand more about his company. Because I thought that the company was really smart here to not only say that his project was safe, but actually demonstrate it. So it brought a lot of curiosity from investors. As you can see, the raise went to close to $5 million, which is one of the top 5 impact investing raises in terms of money raised in the last year and a half. And it also is a company that has the potential to go viral among investors community. This is a company that is attacking a true and tangible problem. We all know about the plastic waste. We all hate seeing plastic in the street, in the ocean, in the rivers, and this company is directly speaking to us. This is also a company that is providing a solution that everybody can understand. And I think that this is one of the reasons why investors were so easily following and trusting Timeplast, because they really knew what the problem was about without having to go through a lot of explanations. The founder and the way he presented himself in the video and on the raise page seems involved. And I've had the tendency to see that this really matters in terms of raising money. So if you're a founder and listening to this talk, I've seen that when founders are really involved and presenting themselves and sharing their story on a raise page, the usual investors tend usually to follow more than investors that are kind of not really presenting themselves on platforms. And 5 million raise for Timeplast is very interesting because there actually are a lot of risk associated with this deal. This is a moonshot. There is somehow an environmental risk, at least if you're not a chemist, if you're not an environmental scientist, and you're thinking about huge quantities of alcohol being sent into water, you can think that there's a risk here, which of course Timeplast mitigates, and the solution is more or less safe from what they have been saying. This is a risk that we can think of. So an adoption risk, a lot of plastic that we have around us is potentially touching water. So we don't know how industrials are going to react to this new product. There's also a technological risk based to the fact that this is still a product at a prototype stage, and this is a pre-revenue company. But still, investors were backing Timeplast heavily. Now let's take a look at Flower Turbines. Flower Turbines is producing innovative and, according to me, pretty beautiful small wind turbines. They also are in the top 10 to 15 companies that raised in the last year and a half in terms of amount invested in their deal. And so the wind turbine that you can see here are actually the biggest that Flower Turbine produces and makes. They have 3 different types, sizes of Flower Turbines, and they are mostly targeting businesses and enterprise locations. So why do I think that Flower Turbine got so much traction? Well, the first thing is that it's a beautiful and very simple product, which is attacking a true and tangible product from an environmental perspective. Most of us know about the issue related to the use of fossil fuel and how we need to transition to a greener grid and fossil-free and carbon-free energy. But also from aesthetics perspective, it's pretty common that when sometimes wind turbines are installed around, the local population may dislike them. Some people might not like the view of solar panels either. And Flower Turbine is kind of trying to solve this aspect of the problem, and that makes them quite unique about them. This is also a company that is providing turbines that have a relatively high cost. I think that the most expensive turbine is close to $15,000 in terms of cost. Of course, this is not a high cost for a turbine, but this is still a high cost compared to a CPG company or a food company. And therefore, this company is going to get its revenue get higher quickly, and this can be attracting investors' attention. And so a US-made company that is offering a quality product. If you go on Alibaba, you're going to see that there are a lot of similar designs, but the quality may be very different. And it's a product that is also performing well. Flower Turbine is promising more energy output with its turbine than competitors. And I really think that differentiation is an important point for investors, and it can be one of the reasons why they will follow a company and invest. Same thing here. Flower Turbine is a company that has risk involved, right? Are people really going to be buying for their companies, for their locations, these small wind turbines? It's also a company that had its revenue kind of stagnating, not really growing between its 2 last raise, but despite that, investors followed. Let's take a look at a last pretty impressive company, Recompose, in the top 20 as well. Recompose is a funeral solution, which is turning human bodies into compost in their facility in Seattle. Recompose is a new product. You may have heard about it, but personally, when I've seen Recompose raising online, I had never heard about this solution. And it's a product that even if it's you, it kind of makes sense. We come from the earth, we eat product from the earth, why not returning to the earth? And I think that is very easy for investors to also understand regardless of their background and regardless of their knowledge about impact investing. It's also a deeply personal topic. And I do think that when investors are involved, they might have a tendency to back some of these impact companies. Recompose founder is extremely scrappy. If you don't know her story, she actually started this company when it was illegal to compost humans in the United States. She found out that one of her local representatives in Seattle had open lunch coffee hours. So she just came in, met with him, convinced him to work on making human composting legal. And that led to the state of Washington being the first one to legalize human composting in the United States. Thanks to her push, there are now something around 8, I think, or 10 states that either already allow human composting or are going to do it in the next few years. And this is one of the best examples of scrappiness that I've seen in a founder. And I know that investors are also seeing that, and seeing that a founder is really involved and moving the needle for this company is a very great sign. And this is a company that had a pretty good revenue, right? If you remember the charts that we look at, 800,000 is really above the norm. And it has also 3.6 million in assets from investors that prepaid the service, waiting for their time to be using for new services. There's still a lot of risk associated with Recompose, right? There's a little risk, there's an adoption risk. Not everybody will want to use this service. There is a time risk. Companies, people that are paying now for this service might only use it 50 years from now. And so that kind of poses risk in terms of revenue recognition from the company. There's also a capital risk. Setting up these facilities cost a lot of money, and the company is also raising at a 70+ million valuation. That can be a risk, right? Having Recompose exit at 700 million or plus valuation to get a 10x is not unlikely, but has less chances to happen than at a lower valuation. So despite this risk, we've seen investors backing Recompose and backing the project. If we take a look at the 20 top companies that really raised a lot of money in this last years and a half, I've seen a few redundancies. The first one is that most of them are tangible products that people can only touch, but also understand. And that I cannot tell you whether it's kind of a cause and a consequence, meaning, are they doing well because this is thing that investor can touch? Or is it that we don't have really a lot of software products because these software products tend to raise more around venture capital and angels? That would be a good thing to dig in and try to understand better. A lot of these products were also beautiful. If you look at Recompose, if you look at Turbines, these are products that are attractive. These are also products that are exciting and bringing something new. They're solving most of the time lost problem, energy, transportation, construction that have large and fast-growing market. A lot of them are expensive. They have relatively high margin, and a lot of the founders on the race page show their personality. They also build visually attractive race page and good marketing campaigns. And in terms of the revenue, well, it doesn't seem like investors one more time are we looking at that. In the top 20, only 10 deals are actually were actually generating revenue, and only one had more than 1 million in revenue. So it really shows us that impact investors are kind of pre-seed to seed investors, that what they can care about revenue is not really what they are looking for. These are also companies that had good traction and execution, but they could have high valuations. And it seems that investors were still backing companies with high valuation. All right, to finish for today, let's take a look at a few deals that did not raise as much money compared to their peer. The first one is Ponex. Ponex raised $20,000 in 3 months and then decided to withdraw its raise from the platform. Ponex is a vertical farming company that is focusing on serving underserved communities, prisons, and food deserts, as well as schools. So vertical farming is growing greens on a vertical stand. And so Ponex is offering what we call a hydroponics solution, meaning that we do not need soil, but only water to grow these greens. One of Ponex had $500,000 in revenue, which could be like a good sign for investors and a real tangible solution as well. But it is a really niche market. And it might be one of the reasons why investors did not really follow on that market. There also has been previous failure. If you remember, around the pandemic time, a few vertical farming companies IPO'd through, SPAC or typical launches, but a lot of them either failed now, or their price share is literally only a few cents. So it's not very attractive for investors right now to invest in a market that did not really prove itself recently. And it can also be difficult to understand why raising greens on a vertical stand while we have a lot of soil available, and the United States being one of the biggest producer of food in the world. If you want to dig more on vertical farming, don't hesitate to go on KingsCrowd. I recently wrote an article after talking to partners that kind of explains more whether investors should be backing vertical farming companies or not. And finally, as you can see, if you go into this article, Ponics has also a few negative externalities in terms of carbon footprint, for example. So the impact here of affordable and nutritious food is kind of unbalanced by the energy impact of what is needed to grow vertical foods. Let's take a look now at Canopy. Canopy is a reusable mask that helps, that prevents the spread of disease during, for example, the pandemic. It's really good because Canopy had a previous great raise of $300,000 raised with a motivated founder, and it's a company that is tackling a real problem related to waste management. But the problem here is that Canopy is what I would call a deflated market. 2 years ago, investing in COVID-related product was an amazing opportunity, but now, I don't know, COVID is, we talk a little bit about COVID, but not that much. And people hope that we are not going to have to use products like Canopy. And I do believe that this is making investors kind of backlash this type of companies. It's also a highly regulated industry with a lot of competition. So it's not probably one of the most attractive deals. And the differentiation, because of the high competition, is pretty low. All right, let's hear REVO Powertrain, which is a company that is retrofitting diesel trucks and buses into electric trucks and buses. Powertrain is great from environmental perspectives. Retrofitting is definitely better than building new, but there is a high adoption risk, right? Why paying a lot of money to retrofit a transportation truck or bus when regulations are not forcing us to do that? It's also not a very attractive business from an investor's perspective. It's not really beautiful, and it can be sometimes difficult to understand. There is also a technology risk that is associated with this race. So my last point here is that in the last year and a half, online impact investors put around $140 million into this deal. And if you look at the fact that most of these deals are early, a lot of them are pre-revenue, as we learned today, I truly believe that online impact investors really themselves have an impact on these companies, and that their checks, whether it's only $100, can push these companies to have a positive impact on the environment, on society. And this is what keeps me excited about this market. Thank you for listening. Devin, I'll open it to the Q&A if we still have a few more minutes.
Yeah, we have just a minute or two, so let's take Jackie Logan's question. She asks, do you have any thoughts on what type of investment security is more attractive? Safes, equity, convertible notes, other?
Yes, I do have a preference for equity preferred. The reason is that in the case of an exit, with what we call usually equity preferred notes, assets have kind of a 1x liquidation preference. That means that if the company sells, investors with equity preferred will get their money back first before anybody else gets returns. So if you invest $100, you're probably going to have your $100 back first before anybody gets additional return. And so I will advise to take a closer look at equity preferred. And it's a very good question because it's very important to look at these terms. It doesn't mean that common, safe, or convertible note are bad, but this is my personal preference.
Excellent. Well, our time is wrapping up, so we better conclude. But Jackie, or excuse me, Leah, thank you. And Jackie, thank you for your great question. But everybody, thank you so much for taking the time to be with us today. We're thrilled and grateful that you could come. We're grateful again to our sponsors and co-hosts, and we're grateful for all of you taking the time to be here. Leah, again, thank you for the really brilliant presentation. We can't thank you enough, and we're truly, truly grateful for the insights that you brought, and and for your patience with the technology today. We're extremely grateful and excited to share your message with more people in the coming days. So thank you very much. Thanks, everybody. By the way, we'll see you next month at the SuperCrowdHour. We will have something great, I promise. Thanks now.
Thank you, Devin.
Bye-bye.